Your tax bill might be higher than it should be, not because of how much money you made, but because of expenses that were not recorded in your books in the first place. Hi, I'm Janie with Sturgeon Bookkeeping. Your CPA can only work with what's in your books. If a business expense never made it in, your CPA doesn't know it happened. You end up paying tax on money you actually spent because there's no record of it in the books. By the end of this video, you'll know 3 of the most common ways this happens and how to stop it before next tax season. If you want your books to work for you at tax time, please subscribe. Your books tell your CPA the story of your business. Make sure it's the whole story. Think of your books as the file you hand your CPA at tax time. If something never made it into that file, they don't know it happened. They can't consider information they never receive. So if you pay for something like a Home Depot run, fuel for today's job, safety equipment, but it never got entered anywhere, that expense doesn't exist as far as your tax return is concerned. It doesn't matter that you spent the money. If it's not in the books, your CPA can't use it, and you might end up paying tax as if that expense never happened. This isn't a tax problem. It's a bookkeeping problem showing up on your tax bill. Let's look at 3 of the most common ways real expenses go missing. The first is cash. When you pay for something with cash, maybe a quick supply run, paying a helper for the day, grabbing materials on the way to a job, there's no bank or credit card record automatically tracking it. If you paid cash and then tossed the receipt in your car, there may not be enough information later to remember what it even was. And if you don't capture it yourself in that moment, the details might be gone. Maybe not from your memory, but from your books, which is the only place it really counts. The second is mixing business and personal expenses. If your business expenses and your personal expenses run through the same bank account, or you're not consistent about which card you use for what, real business costs get easy to overlook when everything's mixed together. And a missed expense could mean a missed deduction, since your CPA never sees it as separate from your personal spending. The third is falling behind. Entering things here or there whenever you can find some spare time means that by December, you're trying to remember the details on a charge from March. Most owners don't remember the details of a purchase, what it was, or who it was for. Instead of guessing and getting it wrong, a lot of that spending just doesn't make it into the books. 6 months later, a Walmart purchase for $63.82 doesn't tell you whether that's printer paper, shop supplies, or groceries. And if you can't remember it, there's a good chance it doesn't get recorded correctly. Now, you already know this matters. It's just that wearing every hat in a business means something has to get prioritized, and bookkeeping is often the thing that waits. It's just what happens when bookkeeping is squeezed in around everything else while running a business. Every dollar of real expense that never makes it into your books is a dollar your CPA can't consider when preparing your return. You've already spent the money, now you may miss a deduction to help reduce your taxes. This isn't about finding loopholes or maximizing deductions in some aggressive way. It's about making sure your CPA has the full, accurate picture of what actually happened in your business this year. Whether a specific expense is deductible and what applies to your situation is a CPA's call. You just want to make sure they're working with the complete story so they have every chance to identify deductions you may be entitled to. Here's an example of what that looks like. Imagine you bought $1,000 in materials with cash, but never got it recorded. If that expense should have been included in your books, your CPA isn't able to consider it when preparing your return because they don't see it. You already spent the $1,000. Whether it could have helped at tax time is a question that never got asked. And it adds up faster than you might think. A missed cash purchase here, a personal account mix-up there, a few months of falling behind, and by the end of the year, that's not one small gap. That's a leak. Sometimes a small leak, sometimes it's bigger than you'd expect. But either way, it's not a one-time thing. It's the same leak showing up again every single tax season until you change your habits. So how do you fix this? Not with a better memory, but with small, repeatable habits. So your daily habit is to capture the details of the expense as close to when it happens as possible, especially cash. Take a picture of the receipt after jotting a quick note down on it first, like what it was for. That can save you from staring at it confused later. A note on your phone, forwarding in an email, whatever's fastest as long as it happens right then before it has a chance to get lost. Your weekly habit is to set the same 10 minutes aside every week to enter what came in and what went out. Same time, same day, so it actually happens instead of getting pushed to later. Your monthly habit is to take just a little bit longer to look. Compare your books to your bank statement. Make sure everything on your bank statement made it into your books, and make sure everything in your books belongs there. That two-way check catches things like auto deductions, bank fees, checks you might have missed, or things you recorded twice or for the wrong amount. This is when small mistakes are easiest to catch, while it's still recent enough to remember what something was. However you handle tracking your expenses, whether it's you or with help, is up to you. Some owners keep it in-house because they like having that day-to-day feel for their numbers. Others hand it off, not because they can't do it, but because their time makes them more money by bringing in the next job. Or because they'd simply rather know that the bookkeeping is being handled by someone more knowledgeable than they are. There's no wrong answer between these options. The one approach that usually doesn't work is waiting until tax time to figure your books out. By then, the moment to record most of the details has already passed. The goal is capturing things consistently enough so that nothing important falls through the cracks. Taxes happen once a year. Your books work for you all year long. They're what let you answer other important financial questions month after month. Making tax time easier is just one of the benefits of keeping your books accurate, and it all comes down to small habits that lead to numbers you can rely on. If you want an easy way to build those habits so you're more confident in your financial reports, I created a free one-page scorecard, a simple monthly check-in for your numbers. I'll drop it in the description below. So next tax season, ask yourself one question about the past year. Is everything I spent making it into my books? If the answer is yes, your CPA is working with the whole picture, and that's the best position you can put your business in. The better your books, the better the decisions and the numbers built on top of them. That's what this channel is about, and that's what we'll keep working on together. I'm Janie with Sturgeon Bookkeeping. Thank you so much for watching, and I'll see you in the next video.